You ever sit back and wonder which is the best ETF fund for your retirement account? If you're looking at Invesco, Neos, Goldman Sachs, JP Morgan, they all have a NASDAQ 100 fund. And you just start thinking, boy, so many different funds. Which one actually works the best? I hear a lot about QQQI. I hear a lot about Goldman Sachs GPIQ. But what's this new QQA that's come out from Invesco? Well, I'm Doug, the Retirement Guy, and welcome back to our channel. We're going to explore each and every one of these questions and give you an idea of how this new QQA Invesco NASDAQ 100 really fits into the swing of things. They're promoting a low-cost 0.20% maintenance fee or expense fee. And we want to just see how is it cranking up. Maybe this is something new that we need to look at. So before we do, I got to do a shout out to all of our over 13,000 subscribers. Thank you and welcome back. We love having you and thank you for supporting the channel. And also our Patreon supporters. And if you're not part of the Patreon family, don't be afraid. Go down the description. You'll hit the Patreon link right there. It's free to join. There's a lot of information behind the scenes. And if you want to support the channel or need additional help, there's ways of getting it right through there. Let's get into today's video of can QQA Invesco ETF beat the Neos QQI or the Goldman Sachs QPIQ? We're going to give it all to you. Which one will attain your goals? We do have to do the disclaimer, and that is past performances don't guarantee your future results, and this information in this video is for educational and informational purposes only. I am not a licensed financial advisor. I am just one who has been studying this stuff for years. The example and suggestions discussed here are basically not suitable for all individual situations, so always contact a financial advisor before making financial decisions. So what is QQA? Well, it's Invesco's QQQ Income Advantage ETF. It's built for income, powered by technology. This thing launched in July of 2024. So we're darn close to almost 2 years old. So when I say new and that, it's just that it's popped up on the screens because people are starting to question about it, asking about it. It tracks the NASDAQ 100, which is the world's most dominant technology companies. It has the holdings of NVIDIA, Apple, Microsoft, Amazon, and it posts a nice 9.43% yield, and it distributes it monthly. And you don't have to sell shares in doing that. So very similar to what we see from QQQI and Goldman Sachs and actually even from JP Morgan. So when we popped the hood on this one, I started doing some research because we did get questioned this quite a bit of times because they said, from what you've taught us, the numbers look very enticing. $729 million in assets, an expense ratio of only 0.29%. So I had to correct them a little bit because they did originally say 0.20, but it really is 0.29. So the shares outstanding, 12 million, almost 13 million shares outstanding. It's paid $5.41 in distributions for 9.54% yield. Now, again, I said it paid out monthly. And right now, the price, the 52-week high is at $57.34. And it's been bouncing at $56.60 to $56.92. And when I look at the chart, that magic number right around $54 is where the fund is played with for almost the entire past year. But now we're getting back up to the 56 with a nice 18.36% growth. So I agree with people saying that these numbers are really looking impressive. But remember, we don't chase yields. We're always looking at total returns. And our total return right around 31.26%. Now that does put it right into the game of the other players. Over the past month, you've seen a 7.22% growth in the total return, and year to date, it's at 11.57. In that 1 year, like I just said, 31.26 with an inception since is 19.33% average, which, like I said, we're getting close to a full 2 year mark. So kind of gives you a good idea exactly where the fund is sitting. So the engine, how does QQA really actually work? Well, this one uses equity linked notes. Where did we hear that from before? JEPQ from JP Morgan. Now, this is a bank partnered option strategy with monthly distributions. So, Invesco, the fund manager, partners with the global investment banks and puts together those packages into those equity linked notes, better known as ELNs, for those monthly distributions. They do the covered calls and the cash secured puts, and it's up 17% since inception. So there's no NAV erosion reported. It paid its income from its option premiums. It didn't have to sell any assets. So kind of a very simplified system of a covered call with covered puts for the security across the board. The main difference is that they're using the global investment banks as their option side of it. So the trade-off that we do, I always say this, is that there is no free lunch. You have to earn your paychecks. You have to earn that price. So in covered call reality is real simple. And the way I put this is for people, when I talk to them on our Patreon thing, is if you own a house and I want to buy your house and you accept my $10,000 offer for your house. And I know that the numbers are ridiculously low, but I'm just using it as, let's just put it this way, $10,000 to buy your house. Now your house triples in price. You're still locked in to sell me that house for $10,000. Okay, the day you signed that paperwork, you were probably happy saying, yeah, I'll take $10,000 for this house if someone would pay it for me. Now, down the road, your house has tripled. You've locked into the $10,000 mark. You don't get that extra $20,000 worth of equity. Same thing here. If the QQA captures and they cap their covered calls at a certain amount and the NASDAQ surges, you're not getting the surge. That's why the capped upside is so big when we talk about covered call strategies. Okay, the funds NASDAQ can surge. You're not getting that. If the plays in the realm that they work with, you're right in line. You're not gaining or losing anything with that. And then when they do the puts, it helps cover that. So they're using it for a smarter way, but these are the downsides of a covered call strategy. So the dynamic edge that they're using that I'm seeing that others are not. First off, the bull market. The covered call reduces 50%, letting the portfolio ride the wave of capturing more NASDAQ upside. Okay, so they're not taking their entire portfolio and doing covered calls across the board. They're using a 50% rule, very similar to what we saw from REC shares. Okay, 50% of their fund is used for covered calls for income. The other side is designed for growth. These guys are trying to do the similar type thing in the NASDAQ version. Now, the volatility of the market. Coverage ramps up to squeeze the maximum option premiums, generating more income while cushioning against turbulent swings. And then they're using active decision making. This is not a static machine. This is human managers reading market conditions and responding. A meaningful edge over passive option overlaid ETFs. So a lot of companies just, they use a system. They have a system in place. All these different rules, we put it in place, set, forget, let it go. These guys are actually using human managers to make those decisions to try to gain as much as they possibly can. So it's kind of I'm going to say a win-win type situation, but an actively managed, to adjust the upsides and the income balance. It doesn't provide the downside protection during severe market crashes, but it does help cushion on the volatility market. So there's a big difference between this using versus a JP Morgan type system. Now, who is this one really for? Well, I always look at the retiree first. It's the retiree use case. You're looking to basically cover your risk of the returns. You're forced to sell shares by depressed pricing to cover living expenses. And this is what we're trying not to get for. So we're trying to find it so you don't have to be buying and selling funds. So a $1 million portfolio with a 10% average yield is going to generate you, realistically about $8,000 a month. So QQA's answer is to live off your monthly distributions. Shares stay intact, the portfolio recovers when markets rebound. So is this a fund for that? Most definitely. It's not designed to make you rich. It's designed to keep you rich. Okay? It's kind of their philosophy. This is their core philosophy from it. So when I looked at this and I said, boy, you guys are talking my language. You may use some different words, but you're really talking my language. So this one is really ideal for retirees and near retirees that want to preserve their capital, work with maybe a little bit smaller margin than other ones out there, but realistically, it's to live off of distributions. So when I sat down and said, let's do a head-to-head comparison, how is this thing really going to fit? Where's this going to look at for different people? And we're going to break it all down by yield, expense ratios, total returns. So QQA really falls kind of short, to be honest with you. QQQI wins the battle at 13.5% in total yield, while JEPQ, very, very similar to QQA, comes in at 10.26%. So we're about 0.75% difference between JP Morgan and Invesco's QQA. And coming up in the tail end of it all is GPIQ from Goldman Sachs. When we look at the expense ratios, now this is something I always say. Just remember, your yields and your total returns will always include your expense ratios. So I don't put a lot of emphasis and a lot of worry into expense ratios, but this is kind of one of their big selling points that people are really liking to see and hear. And the expense ratio is 0.29%, which is tied for the lowest with JP Morgan, Goldman Sachs at GPIQ. Next comes in JP Morgan at 0.35, and QQI is definitely the highest at 0.68%. Now, I got to give it a little boost to the QQA because they are using the human managers across the board. And that's very low for a 0.29 is very low for a human managed program. Now we get into total returns. And remember, on this channel, I love total returns. They tell you what's going on. Well, Goldman Sachs, again, GPIQ, wins with 36.66% total return over the past 12 months. What that tells me right off the bat, when you take a yield of 9% to a 36% total return, you're looking at some big growth in the fund. So you're getting more growth than you are yield. So it depends on where you're at in your retirement travels. You may be coming up a little bit, just getting into retirement, or you're only a couple years away from retirement. This could be a very interesting one because you're still growing your funds to a certain point. Coming in at number 2, QQQA at 31.26. Well, again, you should be able to know this now and see that you're talking a little bit more growth than the other players. Now, Goldman Sachs still has the highest, but QQA comes right in there. So again, where would QQA fit into? It falls into that category of early retirement, maybe just starting retirement, or someone that needs to catch up on a few things but they want that growth. QQQI comes in there at 30.20%. So again, we're about 1% difference, which means we're putting more into income than we are getting from the growth. And JP Morgan, the JEPQ, comes in at 28.72. So the answer to it is, And I know that you start that the QQA wins because it's the lowest expense ratio. But JEPQ from Goldman Sachs wins the total return program. QQI leads on yield. So it really questions you is what are you looking for? Do you need growth? Do you want income to live off of? Do you want a happy medium between the two? I'm not saying any one of these particular funds are bad. I want to clearly just say that because I own QQI, JPQ. Actually, I own all three of those. I do not own QQA as of yet. Um, and I don't endorse and don't push things that I are just because I own it just means, I shouldn't need to talk about it. No, I just want to tell people up front that I do own these things. And QQQI is my income machine. I have it for income because I'm at a point in my life that, if you don't know, I've been retired for 10 years, living off my own distributions and my own, that income side of it, waiting for Social Security to help boost things even more. But realistically, I use QQI as an income. I want that 13%. I want that part. I'm not really concerned very much of growth. I want enough growth to cover my inflation and cost of living type things. They're going up. So I need some growth in the portfolio a little bit, but I really want yield, yield, yield. So, for me, QQI goes into my income category. Now, if I don't need the income, then, honestly, this is where the GPIQ would come into. So I want that growth. I'll put that in my growth particular bucket and take that 10% of yield and really drip it and even add more so I get the full 36% into the growth of a particular fund. So hopefully you understand how I do things, a 3-bucket system of foundation, growth fund, and income fund. So QQI would be in my income, GPIQ would be in my growth side of it, and QQA kind of fits into a magical little pocket. It can kind of go both ways. I would probably use it in my growth side of it and drip that 9.54, but at the same time, always liking having a little bit of something different in the market. Could possibly put that as an income side of it for a conservative package. Let me know where you guys would put yours in the comments below. Let me know if you like the fund or don't like the fund, like what we have available. So it's not the magical new wow, the new piece out there. It's a fund that works differently. But let's take a look at the tax consideration because this really starts playing a big role, especially in retirees and where you want to put this. And the tax considerations, this thing here, you're going to want to put this into a Roth IRA for the best package. A traditional IRA could do the same, but I would not put this in a brokerage fund. I avoid this at all costs because they have really no true hardcore tax program for it. Everything's coming to you as 100% ordinary income. All the distributions are taxed at the highest possible rate. So the ELN structure does not qualify for long-term capital gains treatments. It's for high earnings will feel the most because you're going to put this up and over on top of it. Very similar to what you have with JP Morgan. So it's probably one of these things that is this a replacement for JP Morgan, JEPQ? They're both operating identical to each other, and you're kind of seeing the results are about the same. This one's giving you a little bit more growth than income, and JP Morgan's giving you more income than you are growth. So I want to tell everyone up front, the tax side of it just does not look really good unless you're putting into that full Roth side of it. So my verdict, what I've looked at this and kind of came back and to answer people's questions, there are some big strengths. You really got to, as we put this, is putting this in your tool belt or your tool bucket. The numbers really say the strengths, it's the lowest expense ratio out there. Okay. It's actively managed, which is a huge dramatic change. They're able to watch and have that dynamic option overlay to help keep things on tier. The top tier NASDAQ 100 with the NVIDIA, Apple, Microsoft, very strong, and no NAV erosion on this one again, guys. There's absolutely no NAV erosion since the day of its inception. And it does give you a legitimate 9.54% yield coming to you. So it does give you income. The weakness is really that tax side of it, the 100% ordinary income tax treatment. You really got to be sheltered when you're using this one. It caps the upside in the strong bull markets, and it does trail JEPQ and QQQI for total return and the raw yield. So it's a solid fund. It's a low cost income machine, but it's got to be put into a tax shelter accounts like the Roth. So is this something to add to a tool belt? Yeah, I think you could add this. You could use this in different ways, different pieces, go accordingly. But I will say this, you got to make sure that it fits your goals, your operations of really what you want. So guys, let me know your thoughts. Leave a comment down below. What do you think about QQA? Is it something that maybe will change you from JEPQ? How would you use it? Let me know your insights of it. I'd love to hear your thoughts of QQQA. Also, don't be afraid. Hit that like button. Helps the channel the most. And we'll see you next time.
Thank you for watching. Press the